How are Canadian corporations taxed compared to US entities? US owners often assume that Canada's corporate tax system works just like the US with different rates. In reality, the logic is similar in some ways but quite different in others, especially when you compare Canadian corporations to US pass-through entities like LLCs and S corporations. If you are thinking about forming a Canadian company, it helps to see how its tax life will differ from your US entities before you start moving profit and cash across the border. Basic structure of Canadian corporate tax. A Canadian corporation pays income tax on its profits. Tax is levied at both the federal and provincial levels. The combined rate depends on the province and on whether the corporation qualifies for the small business rate on active business income up to certain limits. The end result is that most mid-sized corporations face a combined rate somewhere in the mid-20s to low 30% range on general active business income, with lower rates for qualifying small businesses. Canada aims for integration between corporate and personal tax. That means when after-tax profits are paid out as dividends to Canadian shareholders, those dividends are grossed up and credit is given for corporate tax already paid, so total tax is roughly similar to what would have been paid if the income had been earned directly by an individual. It is not perfect, but that is the goal. Residence and worldwide income. A corporation incorporated in Canada is generally treated as resident in Canada for tax purposes and taxed on its worldwide income, not just Canadian source income. Foreign income may benefit from relief through foreign tax credits or exemptions, but the starting point is that a Canadian resident corporation has a global tax reach. That is a key difference from a non-resident corporation that simply has a Canadian branch. The branch is taxed only on Canadian source income, and the rest of the company's profits stay outside the Canadian system, subject instead to US tax rules. Comparison with a US C corporation. A US C corporation is also taxed at the corporate level, with shareholder-level tax on dividends. At a high level, both systems tax corporate profits inside the company and then add a second layer when profits are distributed. The differences are in rates, foreign tax credit rules, and the way each system defines taxable income. From a cross-border point of view, the main issue is that a Canadian subsidiary paying dividends to a US parent will usually trigger Canadian withholding tax, reduced under the Canada-US tax treaty. The US parent then deals with those dividends under US tax rules, potentially using foreign tax credits for corporate and withholding taxes paid in Canada. Comparison with US LLCs and S corporations. Things look more different when you compare Canadian corporations to US pass-through entities. Many US LLCs and S corporations do not pay federal income tax at the entity level. Instead, profits flow through to the owners and are taxed only once on their personal returns. Canada does not have an exact equivalent for US LLCs or S corporations. Certain Canadian structures like partnerships and some trusts can act as flow-throughs, but the standard Canadian corporation is not one of them. It pays its own tax first. That is why US owners sometimes use holding company structures or careful dividend planning to manage timing. An added wrinkle is that Canada often treats a US LLC as a corporation for Canadian tax purposes, even if the US treats it as a disregarded entity or partnership. That mismatch can lead to timing issues and, in some cases, double taxation if the structure is not planned with both systems in mind. Withholding tax on payments to non-residents. When a Canadian corporation pays certain kinds of amounts to non-residents, such as dividends, some types of interest, or royalties, Canada generally imposes withholding tax at the source, with treaty reductions depending on the recipient's country and relationship. For a US parent corporation, the treaty often reduces dividend withholding to a lower rate if ownership thresholds are met. From a planning standpoint, this means you cannot just look at the corporate income tax tax rate. You also need to factor in withholding on cross-border payments, then combine those amounts with US federal and state tax to see the total effective rate on profits moving from Canada to US owners. Losses and group planning. Canadian corporate tax does not have a formal group consolidation regime like some countries. Each corporation generally files its own return and uses its own losses, although there are ways to move income and expenses around through transactions or amalgamations. That is different from the US consolidated return system many groups are used to. For a US parent with a Canadian subsidiary, this means Canadian losses usually stay in the subsidiary to offset future Canadian income. They do not automatically flow into the US tax base. The US may recognize foreign losses through its own rules, but the coordination is more complex than simply merging everything on one return. Big picture for US owners. The practical takeaway is that a Canadian corporation behaves more like a US C corporation than like an LLC or S corp. It has its own tax life with corporate level tax, withholding on outbound payments, and its own loss pools. From the US side, it shows up as a foreign corporation that feeds into foreign tax credit and anti-deferral rules. If you are used to running everything through US pass-throughs, it can feel strange to have profits trapped in a foreign company until they are distributed. But that structure is often the cleanest way to run Canadian operations, as long as you model cash repatriation and combine tax carefully. Final thoughts. Canadian corporations are taxed under a system that is familiar in broad outline but very specific in its details. For US owners, the main differences are the lack of pass-through treatment, the need to manage withholding on cross-border payments, and the way Canadian and US rules interact when a Canadian subsidiary is part of a global group. Before you form a Canadian corporation, it is worth laying out how profits will move from customers to the Canadian entity and eventually back to US owners, and what tax shows up at each step. Our website includes visual flow charts that map those cash and tax flows so you can see the full picture at a glance. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share